Hello, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, Chief Executive of Onyx Capital Group. I'm with the research team again this week, Ehsan, Audrey and Vincent, and a bit of a market-focused podcast again. Vincent, what are you going to be talking about?
So today I'll be talking about commodity futures positioning and its relationship with asset managers.
Cool. Audrey?
Gasoline.
Cool. Ehsan?
At the beginning, I guess we talk about the Q2 earning reports. We can have a roundtable discussion about that, and then towards the end of it, I'm going to talk about the metals market a little bit and the similarities to the oil market.
Okay, just quick recap of the past week. So what have we done basically, Vincent, before you launch into your thing on Brent and the wider oil market?
Yeah, so actually the oil market recently has been, I'd say, sort of surprisingly a bit stagnant. Market is quite risk off ahead of some key macro and economic data coming up in the next few days. China CPI Wednesday, US CPI Thursday, and UK GDP on Friday. So until then, Brent crude has been trading around $85. Last week, though, there was a brief sell-off in terms of macro following the Fitch downgrading the US credit rating.
Yeah.
So that caused a quick sell-off, but prices did recover towards the end of the week, and we've been trading around that range since. So the market is really in a wait-and-see mode in terms of the headline macro news.
Okay, so CFTC positioning, was it?
Yes, we've talked about CFTC positioning many times in this podcast, but to highlight something that's quite interesting to discuss is, the market analysts always look at the hedge fund positioning. That's quite interesting because the fast money is what provides liquidity to the market, and they react really fast to macro and headline, so it triggers really fast and rapid price movements. So in the CFTC, we often look at the managed money section, how the longs and short positioning changes over time, and of course the ICE and CFTC must report it in terms of the changes in open interests. And these are all recorded objectively in terms of the lots, how many long positions versus how many short positions, so on and so forth. But of course, the actual trading mechanisms is quite complex because, as futures contracts, it's separated by the different months. So you have October expiry, November expiry, December expiry. But, for a lot of asset managers, this can be very, very complex to manage. They don't really have the time to be trading these, getting in and out of these Brent spreads, or rolling their contracts into the next month, because they have commodities, they have Brent futures as part of a wider portfolio. And of course with commodities, it's there are some benefits to having it, as it helps diversify a portfolio, but also it's very bullish. There's a correlation with inflation as well, as we have seen last year. So, but then at the same time, how do they actually get into, how are they exposed to commodities? Is it through the outright flat price, or is it through perhaps ETFs, commodities, different stuff like natural gas, oil bundled as a part of a wider product? For example, just buying into the SP 500, you're not buying these equities individually, but as part of a bigger pie, part of a basket, part of a basket of goods. Yeah. So that's something interesting to think about, because usually when we analyze this, we're looking at we're seeing how the market thinks. Do they think the price is going to go up or go down? But then people also look into the ETF money inflows and outflows because of the huge amount of money going into these ETFs. By looking at how much money is going in versus how much is going out on a weekly basis, it also gives an insight into how these asset managers and institutional investors are positioning, which therefore implies, on an overall basis, whether they think prices are going up versus if they think prices are going down. So that's another layer to just purely the CFTC positioning. Yeah. So I suppose there's two layers, two sides to the story.
Yeah, it's quite interesting because the way that I think about that is a reference to the Big Short movie, where there is Selena Gomez explaining that secondary markets, secondary bets in the markets that are and if you think about, right, so you've got the actual contract, you've got the Brent, and you've got the TI and positioning in those. But if there is another contract that is closer to, equities where people can trade and don't care about like the contract expiry and rolling and all of these, then there is more interest in those ETFs. And the amount of money that there is in these secondary markets is actually become so big that sometimes they do have a direct effect on how the Brent futures trade or the TI futures trade. I think on that day that we saw a sell-off, a macro sell-off, that was quite interesting because ETFs like Wisdom Tree, Brent, or USO, United States Oil Fund, on those dates, it was the time that those ETFs reached the all-time highs for 2023, and all these investors that they had a stake in those ETFs found an opportunity to liquidate their positions because these levels were not seen on these ETFs, and there was a big outflow of money on those ETFs. And in a way, you could think that, right, people are taking their money and investment out of those ETFs, and that's going to like put pressure on the actual contracts or commodity contracts like Brent and TI, which we saw on Thursday last week.
So when you say secondary market, though, I don't get what you mean by that.
So the actual mechanism for like ETFs, the fund manager basically like decides on how much they want to purchase in TI or Brent.
No, that's ETPs, right? So ETFs is just a long only or short only.
Yeah, but what I mean is like the actual like holdings of those ETFs is like,
well, it's notional. They either leveraged or it's like 1-for-1.
Yeah, but it's like, I mean, like the weighting of like what contract that you're going to put as your holdings. So like, for example,
like the Goldman Sachs index has got all the different commodities, and they're saying that weighting is decided by Goldman's.
So for these ETFs, there is a fund manager who decides to like how much money they're going to allocate to cash and how much they're going to actually purchase contracts.
Well, it depends on the ETF. So you're saying there's asset managers that are doing like the advanced beta stuff, which is like they're creating these systematic strategies. You're buying into ETF, but you're at their mercy of how they allocate.
Exactly. And like each asset manager wants to do well with their ETF, right? Like, because like performance is going to be the main driver of like how much people get involved.
But I know what you're trying to say, but I would call that more like risk parity investments, right? That'd be into hedge funds, or even pension funds and all that. Like, I don't think like ETFs, when I think ETFs, it's very binary, right? You're buying into like USO, it's like it's WTI. That's what you're buying.
Yes and no, because I think so what I've seen as a trend was, they all have cash reserves, right, in their portfolios. So like, for example, USO at the moment, I think the net asset under management is around 1.6 billion dollars, but the amount that is actually invested in the crude contracts, it's not exactly 1.6.
Okay.
So like there's some cash that they have.
So it's long only, but they say if we're bearish, we're just going to hold everything in cash.
Essentially, like purchase less.
Yeah, I didn't know that. So that's a classic long only fund strategy, right? As in like just pick your moments to be long. Essentially, I remember you in Market Wizards.
Yes,
there was a guy who was saying like he done really well, but in basically long only equities as a fund manager, and he went into long short. He said it was crap because like when you're long short, like they expected to beat the benchmark on the way up and beat the benchmark on the way down. Whereas if you're a long only, people are like really happy if you don't lose as much as the benchmark, and obviously they're really happy if you beat the benchmark on the way up. So yeah, do you know what, I'll be honest, I didn't realize that was so much on the ETF side that was that common. I thought it was fair enough.
Yeah, but it's
so who is doing that? I'd be curious because they're effectively running a big discretionary position.
Yeah, so it is the United States oil fund,
and there's still going to be a couple
LLC.
of guys there sitting.
Yeah. So I think we can like find the details of like who's the
because they're going to be responsible for a fair amount of inflows and outflows.
Yeah, I mean like the performance obviously is related to how Brent performs. So like you can't actually be like so upset that that your ETF is not doing well because your fund manager is not doing well. It's like
That's exactly what I'm saying.
portfolio
I always saw it as like you get these into these ETFs because you're like, I want to buy Brent or WTI. I don't want to do it through a retail platform. I want someone else to risk manage it, but I do just want long exposure. So that's why I was saying, what is this? What do you mean by secondary?
No, the moving part, what actually moved the prices is the price of WTI and Brent. Yeah. Because like the rest is the cash reserves, and other part that is into it. So if I share my screen, actually, like that would be quite interesting. So like for the listeners, I'm showing the holdings of USO, United States Oil Funds. So at the top we have October, November, all the way down to March 24, and the market values for each of these contracts that contribute to the holdings. But also, you've got these swaps that give you some sort of other exposures. Again, like those swaps are closely related to WTI, but then you've got some US dollars that you're holding, and some cash reserves that you're holding as well. So like you have a little bit of room, to play with how much you want to leave as cash reserves and how much you want to leave as
the fund managers do.
The fund managers. But I haven't actually done the study, but it would be interesting to see like how does this year compare to last year? Because what I'm assuming is last year, as a fund manager, you didn't want to actually you want to reduce your cash reserve in US dollars and like bring everything into WTI and Brent because they're performing really well, much better than US dollar. So it would be interesting to see the difference between last year and this year, and how the money is distributed.
Yeah, I agree. It says the investment policy, the fund seeks to reflect the performance of the spot price of WTI, blah, 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 by investing in a mix of oil futures contracts and other oil interests. The devil is in the detail.
Yes.
I guess that gives them the leeway to trade other things.
Exactly.
Because it's not, well, if you say it's seeking to reflect the performance of WTI, then if you outperform WTI, isn't that a bit...
Yeah.
Anyway,
how do you do that? Yeah.
That's really interesting.
Yeah.
So was that your general point, Vincent, that basically there's these strategies going on that involve oil and therefore influence oil because there's a lot of buying and selling from them, and it's not just speculative, we're going to buy, we're going to sell. It's based on risk parity, changes in so for example they might reduce the Brent holdings because something else has changed on the macro stage. It's not necessarily to do with fundamentals or headlines.
For sure, it's related to the money flows, but at the same time the first stage is looking at the open interest longs to shorts, and of course you guys had this big discussion about the mechanisms of ETFs, the money inflows and outflows. But what I'm trying to say is, at the same time, it's not only, of course, you have the risk parity, you have the CTAs, the different sort of investors within the managed money. But also means that, you have these like big institutional investors, their positions aren't necessarily reflected in the CFTC report, and that their exposure isn't directly related to they're trading their exposures on the secondary market in Brent or WTI via the ETFs or via the various funds ETF, from advisors.
You have to go in and execute at some point, or is what you're saying.
So the ETFs they have direct exposure through they have the open interest in the futures
the exchange. Yeah.
But if I was an investment advisor, I might put $10 million in the USO, but that wouldn't be reflected in the CFTC data. It would be like I would put the money into the ETFs, but my exposure isn't related to the longs and shorts in the managed money.
But it does get there at some point. I think
at some point, but not outright.
So the difference is, for instance, United States Oil Fund LLC advisors. Those are the guys who actually take position in WTI, which is 3,000 lots, let's say, in the front contract. But the actual exposure on that ETF is a lot more than the amount of money that people have put in the actual ETF is a lot more than the actual 3,000 lots in the front.
Is that what you're saying?
Yes.
Okay,
yes.
Cool. Another. I get your point now. So the other thing is that retail guys. So retail take the other side of these traders or investors' risk, And sometimes, or a lot of the time, they don't go and back out into it because they're like 80% of the time you lose money. So if you're long, we're short. And they don't go and back it out into the market so that you can have investor risk in the market. Yeah, and it's actually a great wider point because do you remember we was going on about it last year, how producers didn't hedge at the beginning of last year and the back end of 2021 because everyone said it was going to go to the moon. By them not hedging, that is a long position in the market because at some point they're going to have to come in and sell. And therefore, them not selling is effectively draining sell-side liquidity. And that's what you're saying with ETFs as well. Like there's money there that's ready to go. It's not been utilized yet. So that's a really like nice like way of looking at it. Like if you could map all the dormant positions, that would add a huge another layer of, that's super interesting.
So to that, actually, I think if I can share my screen one more time. Now you're looking at, again, USO, and we're looking at the ownership type of the USO. So like it's around 23% of all the positions that is put on the USO is from the brokerage flows. So these are all your resale back-to-back flow.
Sorry,
20% of like all the open interest that there is on that ETF is from brokerages. So like these are the people who actually want to get
like IG index.
So like all of these platforms that allow Fidelity, your HL, your IG, so these sort of things.
Cool. So Audrey, gasoline.
Yeah, so we've kind of brought it up every week for the last couple of weeks. So this week I was kind of just touching on some indicators that, maybe the rally is going to come to an end. So obviously, looking at the CFTC, I know you were talking about, maybe it's not everything here, but we mentioned a couple of podcasts ago, if people can kind of like bring their minds back about how one of the key indicators that, the rally might be coming to an end is going to be when we see like that flip in RBOB positions in the futures. So this week we saw the build again, so I can bring this up on screen if you like, but we see the builds of the spec positions. So these are the managed by money positions, the speculative positions. So we saw another build in length, but we can see, if you look at the graph, like it's a lot more muted than we had been seeing in the past couple of weeks.
What are we seeing? You're saying
so these blue bars here are the speculative length percentage builds week on week. So you can see like that percentage build, it's only like
diminishing
1.2%.
And shorts are massively increasing.
Shorts have actually also been decreasing massively.
Oh, okay.
Still. So I think
I think the shorts were quite little, right? So on percentage basis it showed like a lot, but like in real terms it was like it
was 26%. My point being that that's one indicator of the rally, beginning to come to an end, is we're starting to see these longs, or at least that super bullish interest. We're not seeing much more coming in. Obviously last week what we saw as well, if you looked at the RBOB futures prices, just absolutely came off a cliff. That was also on the back of that bigger kind of macro Fitch downgrading the US buying from AAA
what did
to
the
AA
crack
plus.
do during that period?
What I was kind of interested in this week though was actually in butane. So if we start kind of thinking about, what is kind of the main driver of gasoline prices that summer driving demand season, and what we're starting to see now is actually butane prices starting to rip higher. This is obviously on the back of people starting to position for the winter gasoline blending. So I'm thinking that maybe people are starting to kind of look towards winter season now. So you can see just kind of from the beginning of July. So if we look,
what contracts is?
So this is butane. So this is LST butane in Mount Bellevue.
US butane.
US butane in Mount Bellevue. Yeah, I kind of also graphed the difference of the LST, but you can see, when it starts to come off a cliff, after that winter, you can see that coming off, as we go into the summer demand season. And then recently we're starting to see that build up again. So we're seeing a lot more buying interest in butane, which is kind of indicative of people are starting to position now, starting to turn their attention towards winter, into winter blending demand.
It would make sense actually. The Q4 margins were low for a lot of this year, and now they've picked up quite a lot. Well, I guess with the rally, Q4 has been dragged up by the Q3 buying. But the other thing is, refiners have all the evidence is that they've been buying the crap out of like crude related contracts to lock in this refinery margin. I don't know if they've been selling the products on the other side of it, but the point is that if they're committed to produce or to running at a high rate, they don't really care what the product prices are doing. They've locked them in on their hedge and they're committing to this. Therefore, you genuinely need the butane because you're going to need to be blending the finished product, which is winter gasoline. So if it was still up in the air whether or not they would produce as much. Do you know what I mean? So it's a good indicator that things are going to be running quite hard. And so in a way, it's kind of bearish the refinery margin Q4, but it's pretty bullish crude, I guess. So there's going to be the reliable purchases there.
Yeah, and my other point as well being this week is gas oil. Again, my kind of whole point being that people are starting to turn their attention maybe away from gasoline, being super bullish gasoline in summer, towards being more bullish in gas oil in winter, looking at that gasoline blending for winter, that people are just starting to look at the winter products now a little bit more than all these summer products. So being less bullish in gasoline. If you look at like our COT dashboard that we have as well, looking at EBOB cracks, the market's pretty balanced. So we're not seeing as much, buying appetite in the ARB as well. We're not seeing
Have we seen a lot of profit taking in EBOB then?
Yeah, we've seen this kind of throughout the summer. But if we go back to last week's data, so I'm going to pull up our Onyx COT dashboard now. So you can see here, if you look at, say, the front contract, you can see there was a lot more selling in the 7-day flows up until the 1st of August. So that's likely profit taking, because then what you can see is the length starting to build up again from then up until where we're at now, which is a pretty balanced market between buying and selling. And if I just jump to our flux pricing, so I think this one's quite interesting. So this front spread here, this SEP Oct EBOB spread.
Sorry, can we go back to the positioning, because that was something interesting, especially like if you go last week, the one that you were showing that like there was more selling.
Mondays.
The open interest is actually not showing that much build, but like the interest is on the sell side. It's like a clear sign of
length exiting.
Yeah, positions like exchanging hand and length, basically like selling out of their length. So it's not like new selling. It's essentially like people who had put on length.
It's not new interest coming in.
Exactly.
It's people stopping out of positions. Which is indicative of
profit.
taking.
Profit.
Exactly.
Okay.
And we actually put out a trade idea in some of our reports. I'm sure some listeners might have seen that, of actually, our idea to get short the SEP Oct EBOB spread, which, obviously
So it's quite ballsy, but
took profit.
Hurricane spread.
Yeah. But also on the hurricane thing, so I think, that's something that people have obviously been keeping in the back of their mind. If I actually just bring up this from earlier in the year, so this actually came out in May, where they predict what hurricanes are going to be like for the year. The chances of hurricane season being above normal, or in the odds of this taking out like significant infrastructure, it's 30% higher than normal. But that means that near normal is 40% and below normal of 30%, and we haven't seen hurricanes affect infrastructure in the US significantly yet either. Obviously this can go on till November, but as of yet it hasn't taken out anything in the US, and it's around now to September that this is kind of the biggest threat, rather than into October, November. We haven't seen that happen yet, so again, something to definitely keep an eye on. But I think that isn't a super bullish driver. It's not really driving people into bullish positions.
Yeah, I guess because it's rallied so much already, right? Like the absolute levels of SEP Oct, you've got to effectively like a hurricane inspired level, that you usually get these levels when there's a hurricane or a big outage. If you've already got that, then, your risk reward for expecting it to go, even higher, it's possible. But I think that, it just reduces that risk reward. And actually on the short side, you could argue, if you position size correctly, at the end of the day, like, it's already at those levels, and that's kind of how people work, right? So
and I think that kind of ties into the CFTC as well. It's like why we're seeing that such small build now in length, that maybe now we're just seeing a saturation. And anyone that
the guys who trade it, they've been doing this year in, year out. They always get long these months. Like they know the levels better than anyone, right? So
it's interesting, like that kind of flow starts from right. So now the gasoline traders, I assume that they are looking at March 24, right? And then back in December, they were looking at these months that are expiring now, and like it's a classic thing that happens every year, right? But one thing that is quite interesting, like money managers' positioning has not changed that much, but and back to the point that you were making as well, Greg, about the refineries taking hedging these levels, is definitely a trend of like short building up in the Prodmerg category of the CFTC on both RBOB and New York Harbor ULSD. So it seems like the levels, we discussed this in the last podcast as well, that like, right, how how much can these two contracts rally, especially that they are like so out of the technical region, and also at some point the refiners got to get in and lock in these levels, and there is evidence of that happening, and this could be one of the reasons that we saw a little bit of pressure on the RBOB levels, RBOB crack levels, and ULSD as well. ULSD less, but RBOB crack a lot more.
It's worth, Audrey, if you pull up the COT for ARB, September 2023, and you'll see the
It's pretty balanced in the 7 days.
Yes, that's exactly what I'm trying to say. And looking at the open interest, there was a big drop off recently as well.
This is gasoline ARB, so
Gasoline
the US,
Yes.
Europe into US.
The OI is well above.
Physical.
Oh yeah.
Well above. It was accelerating, but there was a large drop off in the past week as well.
Yeah.
So a lot of shorts were getting in before, so that really magnified the EBOB, the European gasoline rally. But now we've seen some more buyback flow, a lot of profit taken from shorts as well. So if you pull up Flux September TA ARB as well, you'll also see that price action had been trending down a lot. And so the shorts that have gotten a lot of natural sell side hedging, now they're quite profitable on the paper, so they've bought back their shorts, and that's what we've been seeing, and that's what the open interest and our position data ought to show as well. So that's all reflected, that's a reflection of the huge interest in gasoline over the summer, but perhaps now people are more focused on the winter, onto butane.
Yeah, and I think also
blending.
like imports into the US last week, which has obviously been the key driver of strength in Europe. So US imports of European gasoline dropped 14% week on week to August 3rd. So, down to 270,000 barrels a day from 314,000 barrels a day. So I think if we keep seeing that trend as well, that's going to be very indicative of, the summer rally kind of coming to an absolute peak now, having already peaked.
Very interesting. Okay, Ehsan.
Yeah, I don't actually know whether we have enough time
Let's
to go
just-
through this. But
same as last week.
We've talked about like if you.
That's why I always come to you last.
Yeah, can I start next week? Yeah, and leave halfway.
Okay, earnings reports first, right?
Yeah, I think I'm gonna talk about that, and then maybe like we'll leave the
Metals for
metal
next
stuff.
time. Yeah,
next
yeah. I
time,
mean, it's
because I
timeless,
think
that
it's
stuff.
yeah, and then it's like completely going into a new thing. So that maybe we'll talk about it later.
Part 2.
Yes,
We'll
exactly.
get a metals trader in as well.
Yeah, you
Yeah.
should definitely get Lawrence.
Yes.
Oh yeah.
All right, cool.
Right, so sharing my screen, we're looking at the Q2 reports of a couple of big companies in the oil and gas space. So like we're looking at Shell. I'm not going to read all of these, but I'm just going to show like a few of these reports and then like go through the summary. But the main theme is that obviously in comparison to last year, the current earnings have seen a big drop, and it's reasonable because the price of crude in Q2 22 was a lot higher than it was this year. But as a summary of looking at like Shell, Chevron, Exxon, and Saudi Aramco, and mix that up with the actual price that was trading in Q2 23 and Q2 22, the drop in the Shell, Chevron, and Exxon has been like a lot more significant. But in the news outlets, I think Aramco's decline in their earnings got a lot more attention than the rest of the companies, especially off the back of their production cuts. But the numbers, I know, like on an actual level basis, like they've done $18 billion less than last Q2 in 22. But on percentage basis, they are a lot closer to the average crude price dropping than any other company. And I don't think that like the Saudi Aramco's trading operation, especially like on the financial side of things,
Is that big? Yeah,
Is
yeah.
that big?
Well, it's
As-
growing a lot. I
Yeah.
think it will be. That I think is what it is. So it's all relative, right? So they did so well last year because of trading, probably mainly, not mainly, but the guys who have big trading outfits,
contribution,
particularly
yeah.
Shell, such a big contribution before, a lot worse trading conditions this year for them.
yeah,
So therefore that expected increase wasn't there, plus the price has gone down. So it kind of makes sense that it's kind of overextended on the downside. And like you say, that Saudi Aramco might have a trading operation, but it shows you how big their production is, that it barely makes a difference. But it's also the Saudis, like, it's about this budget concern, right? They need to plug the hole. They just got their, win the last month. That was much needed. And they've also risen prices to Europe and Asia. Like, you can see what they're doing, right? They need to get back this cash, considering they have less production out there. So that all makes sense. But I guess quickly
about
to add
the production
as well,
numbers as well. I think it's something that was in their quarterly and like report. So they're actually producing more than Q1, but their production is mainly on the gas side. So oil production has dropped, but overall oil and gas together, they're actually producing more than Q1 this year. So there is a lot of gas flow, gas production, that is maybe compensating some of the loss.
That's a good point, actually.
That they are seeing from like lack of production in oil.
Interesting. Do you know what? I think we'll leave it there, but there's so many things I want to bring up, but I think that'll be for next time. So thanks for your time, guys. We will leave it there, and thanks listeners out there. Again, we've talked a lot with graphs lately. We got some feedback on that. We've tried to push that. We'll continue to push that. Makes for a bit more of a dynamic kind of interaction. Please check us out on YouTube to see all that, and tune in next week. Thanks again.
Cheers.
Thank you.